Imagine standing at the crossroads of $1 million decision. A new project, a risky investment, a bold business expansion. The future is uncertain, but one question echoes in your mind. Is this worth it? Every entrepreneur, every manager, and every investor faces this moment of truth. Will today's investment bring tomorrow's reward, or will it drain resources and sink ambitions? The answer lies in one powerful financial tool. A tool that sees through the fog of uncertainty, that peers into the future, and translates tomorrow's promises into today's value. This is net present value, the key to unlocking the hidden potential of your investments. But how does it work? Why is it trusted by top leaders and analysts worldwide? Let's unravel the mystery of NPV and learn how to make decisions with clarity and confidence.
Project Financial Evaluation. How to calculate returns from a Six Sigma project investments. Here in this lesson, we shall discuss a few very widely used financial approaches for benefit capturing for any investments or expenditures. Financial evaluation is the process of comparing the financial benefits of a project with the financial cost. There are many concepts of analyzing this aspect. Here, in this lesson, we shall restrict our discussion to the ones that are in everyday use for evaluating Six Sigma projects. These are return on assets, return on investments, net present value, internal rate of return, and payback method. We shall divide these lessons in multiple sessions.
In this session, we shall discuss net present value, or NPV as it is called generally.
Net present value, or NPV, is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is used in capital budgeting and investment planning to analyze the profitability of a projected investment or project. The formula for NPV is here in this formula. I equals required return or discount rate, and T equals number of time periods. Note that cash flow in period 0 is also denoted as the initial investment. If you are analyzing a longer-term project with multiple cash flows, then the formula for the NPV of a project is here, RT equals net of cash inflow and cash outflows during a single period of T. I equals discount rate, or return that could be earned in alternative investments. T equals number of time periods. For example, imagine a project that costs $100,000 today and will provide equal cash flows of $10,000 over the next 10 years. Look at the table. In this example, the cash outflow at T equals 0 is $100,000. The minus sign refers cash outflow. Now, after every year, using the NPV formula, we calculate the net present value of yearly cash inflows. These are noted in column D. It may be noted that the present value of total benefits is $61,446. Now, using the formula, NPV equals $61,446 to $100,000 equals minus $38,554. Here, note that though we would accumulate a total of $100,000 over coming 10 years, at a discount rate of 10%, in today's value, the project will be at a loss of $38,554. In the NPV calculation, the required rate of return is used as the discount rate for future cash inflows to account for the time value of money. Remember that $1 today is worth more than $1 tomorrow. Therefore, when calculating the present value of future income, cash flows that will be earned in the future must be reduced to account for the delay in time. Let us take one more example. Here, in this project, for a $3,000 initial investment, at a discount rate of 8%, the future cash flows at the year end, over coming 3 years are $1,500, $900, and $2,400. Calculated the same way, as we have done in the last example, the NPV is $1,066. This is positive. You may note that NPV can be both positive and negative. Depending on the value of NPV, a decision on new project may be taken, whether the new project will generate revenue for the organization, or is it worthy to implement the project. Carefully look at this table. It explains in brief what means if the NPV is positive, negative, or zero. If project NPV is greater than zero, the investment will increase the value of the firm, and therefore, the project may be accepted. If project NPV is less than zero, then the investment would reduce value of the firm, therefore, the project proposal may be rejected. If NPV equals zero, then the investment would neither gain nor lose value for the firm. In that case, project adds no monetary value. Decision should be based on other criteria, such as employee satisfaction, strategic positioning, or novel qualitative factors.
Dear viewers, here we end the session. Now is the time for the quiz. Test your understanding and enjoy. There will be 10 questions and 4 options for each question in a multiple choice format. Pause the video and select the right answer, and then compare. We shall also explain the answer for a better understanding. Let's start the quiz.
What does net present value NPV primarily measure? Options are profitability of a project, liquidity of a company, return on investment in percentage terms, risk level of an investment. The correct answer is profitability of a project. NPV measures the profitability of a project by calculating the difference between the present value of cash inflows and outflows. Next, which discount rate is commonly used in NPV calculations? Annual inflation rate, weighted average cost of capital, WAC, prime lending rate, internal rate of return, IRR. The correct answer is weighted average cost of capital. WACC is the most common discount rate because it reflects the company's cost of capital and the expected return from investors. Why is it important to consider the time value of money, TVM, when calculating NPV? The options are: it helps in comparing future cash flows accurately, it ignores the cost of capital, it assumes cash flows are always constant, it reduces the risk of investments. The correct option is it helps in comparing future cash flows accurately. TVM recognizes that $1 today is worth more than $1 in the future due to its earning potential. Next, which of the following scenarios could result in a negative NPV? The options are: cash inflows exceed cash outflows, the discount rate is lower than the return rate, future cash flows are overestimated, the initial investment is zero. The correct option is C. Overestimating future cash flows leads to inaccurate NPV calculations. This may possibly result in poor investment decisions. Next, how does NPV help in comparing mutually exclusive projects? The options are: by comparing total cash inflows, by calculating future profit margins, by selecting the project with the highest NPV, by considering only the initial investment. The correct option is C. When choosing between mutually exclusive projects, the one with the highest NPV is usually the best choice, as it promises the highest value addition. Next, a company is evaluating 2 projects. Project A has an NPV of $5,000 and Project B has an NPV of $4,500. However, Project B has a lower initial investment. Which project should be selected? The options are Project A, Project B, both projects. You need more information. The correct option is A. Generally, the project with the higher NPV is preferred, but factors such as IRR and payback period might also influence the decision. Next, a project's cash inflows are $1,000 annually for 5 years. If the discount rate increases from 5% to 10%, what will happen to the NPV? The options are: it will increase, it will decrease, it will remain the same, it will turn negative. The correct option is B. As the discount rate increases, the present value of future cash flows decreases, resulting in a lower NPV. Next, how does the choice of discount rate impact the outcome of an NPV calculation, and why might different projects require different discount rates? The options are: different discount rates adjust for varying levels of risk. Higher discount rates always make the NPV positive. Lower discount rates ignore future cash flows. The discount rate does not affect the NPV result. The correct answer is A. Discount rates account for the risk and opportunity cost of capital. Different projects might have varying risk profiles, necessitating different discount rates to accurately reflect their potential returns. Next, why might a project with a positive NPV still be rejected by management? The options are: the project requires minimal investment, the cash flow projections are conservative, there are strategic non-financial factors to consider. NPV is the only metric used in decision-making. The correct option is C. Management might consider factors such as strategic alignment, social responsibility, or resource constraints that go beyond financial metrics when deciding on project approval. Here is the last one in this quiz. How does sensitivity analysis enhance the understanding of an NPV calculation? The options are: it removes the discount rate from the equation. It tests how changes in key variables affect the NPV outcome. It predicts future cash flows with certainty. It simplifies the calculation by ignoring cash inflows. The correct answer is B. Sensitivity analysis helps determine how changes in variables such as discount rate, cash flows, or project duration impact NPV. It provides insights into potential risks and project stability.
End of the session.
Before you go, don't forget to hit the bell icon. If you haven't subscribed yet, now's the time. Don't miss out on the latest insights. I look forward to seeing you in the next video.